Getting to grips with selling online. Welcome. This is Al Johnson. We want to tell you all about selling online in 2021, what you need to do, and what you need to do in terms of your accounting and your tax, and making sure your business flies and grows at such a beautiful and wonderful time to start selling online. In the last year, there's been a surge in online sellers and marketplaces as businesses attempt to deal with the restrictions placed on everyday life by the pandemic. Within the first 4 months of the lockdown, more than 85,000 businesses launched online stores or joined online marketplaces, according to research. And since then, many more have sprung up as both new entrepreneurs entered the market and established businesses build successful e-commerce offerings. According to Statista, the United Kingdom is now the third largest e-commerce market in the world. However, this surge in online selling is not just a product of the pandemic. For years, more and more consumers have been shunning high streets and retail parks in favor of online marketplaces and shops. After all, there is a reason why the likes of Amazon are now the world's biggest retailers. This shift has only been accelerated by the events of the last year, which has changed both consumer and business spending behavior considerably. There are, of course, many benefits of operating a business that sells online. People often cite the lower cost of operating outside of towns and city centers, as well as the ease of scaling up. Important considerations for online selling businesses. There are a number of things that both new and established businesses need to consider when setting up shop online. Based on our considerable expertise in this area, this presentation will go over some of the important steps and considerations, including setting up an online sales business, bookkeeping and accounting for online sellers, pricing models, VAT on online sales, selling to customers overseas. At the end of the presentation, there will be time for a short Q&A, or if you would like to go into more detail on any of the points covered, why not arrange a free initial consultation with me? Booking details are available on our website, rjohnson.ltd. Setting up an online sales business can be very exciting, but it is not without its challenges. There are certain steps that all new entrepreneurs will need to consider when launching their enterprise. This might include what business structure to use, setting up business banking, investing in insurance, or careful tax considerations. We have helped a number of clients set up new online businesses, helping new owners to navigate the complexities and opportunities they face when they launch their business online. We have helped existing businesses to diversify into the world of e-commerce, either through their current company or by helping to launch subsidiaries. Company structure. When launching a new business, entrepreneurs must consider their company structure. This could mean operating as a partnership or a sole trader, or in most cases, incorporating the business as a limited company. Choosing the limited company structure brings with it many distinct advantages when it comes to tax and personal liability. But entrepreneurs should also be aware that it also has several important obligations and responsibilities. A limited company must be registered with Companies House, and you need to provide details of the registered office and the company officers. This includes naming people who have significant control of the business, persons with significant interest. Companies need to appoint at least one director as part of their incorporation. If you do not have a commercial premises and do not wish to use your home address as a registered office address, you could use your accountant's address for a small annual fee. However, this cannot be used as a trading address. If you do not want to immediately establish a limited company, despite the benefits it offers, we can also help you with the requirements of being a sole trader or a partnership. In the future, as your business grows, we can help you alter your business structure to meet your evolving requirements.
Thanks, Robert. Let's talk about banking and insurance. The company is required to have its own bank account. The bank will need a copy of certificate of incorporation to set up the account. You can also open a saving or reserve account to help reserve funds for your tax bills. When setting up a business, you may also need to ensure it is protected by insurance. Generally, there are 3 types of insurance you need to consider when setting up a business, and these are employer's liability insurance, public liability insurance, professional indemnity insurance. However, in light of recent events, it may also be worth investing in a comprehensive business interruption insurance policy, which explicitly spells out what payments will be made in the event of a pandemic or similar event. Hiring and paying staff. At some point, you may need to recruit employees as your business grows. If you intend to pay a salary to yourself or others, then you will need to set up a payee scheme with HM Revenue and Customs. HMRC will issue a reference number to the company for the scheme. Once this is set up, you will then need to calculate and deduct the payee and national insurance every time you pay your staff. This is payable to HMRC monthly or quarterly. You are also required to notify HMRC each time a payment is made to an employee. This is known as RTI, or real-time information. If you are paying yourself a salary, then you are required to also run this through the payee scheme. The right levels must be chosen according to your personal circumstances. In some cases, it may be beneficial to pay yourself a smaller salary and dividends to reduce the amount of income tax you are liable for. You also need to consider the provision of pensions to staff. Under the complex rules of auto-enrollment, all employers have to provide for their qualifying workers by enrolling them in a workplace pension scheme. This includes staff member aged between 22 and state pension age that earn at least £10,000 per year and work predominantly in the UK. It is recommended that you issue formal contracts of employment to your staff. This should set out the standard terms and conditions of their employment, including the salary and benefits they will receive. Companies House reporting. Every limited company in the UK is also required to file accounts with the registrar at the Companies House. Accounts are usually made up to the business accounting year end. The company's year end is originally set on the month in which it was incorporated. So it is possible to change your company's year end, but an accounting period must not exceed 18 months. There are also restrictions on extending the year end more than once in 5 years. The annual accounts must comply with the Companies Act 2006, including the format and notes to the accounts. Smaller businesses can file filtered accounts or micro accounts if certain conditions are met, which means that they do not need to file a profit or loss account on the company records. The accounts must be filed with Companies House within 9 months of the accounting date. There are strict penalty regimes for late submission of accounts enforced by the registrar. Every limited company is also required to file Form CS01 annually with the registrar. This form confirms the registered officers, shareholders of the company, and the persons with significant control. If you use our office for your registered office, we will take care of this for you. Corporation tax is paid by a limited company on its net profit after allowable expenses and capital allowances. The current corporation tax rate in the UK is 19%, but there are a variety of reliefs that a business can take advantage of to reduce their bill. Corporation tax is always calculated based on the accounting period to maximum of 12 months. If your accounting period is more than 12 months, you will need 2 tax returns to cover the period. Corporation tax is paid, must be paid to HMRC 9 months and 1 day after the accounting period, provided that the accounting period is not more than 12 months in length. If the accounting period is longer than 12 months, the profit will be split, and there will be 2 payments due to HMRC. 1 9 months and a day after the first 12-month period, and the second 9 months and a day after the accounting period and date. Once you have registered your limited company with Companies House, HMRC should be advised that your company exists. It will then contact you and ask you to complete the form CT41G confirming your company details, which will indicate the company's unique tax reference UTR, which is a 10-digit number, and the company's allocated HMRC tax office. This will allow you to report and pay corporation tax. Online business models, as well as figuring out what structure your business should take. Owners also need to think about the type of online business they intend to run. There are a number of variations to consider, which I will now outline quickly for you. Business to consumer. B2C businesses sell to their end user. The B2C model is perhaps the most common business model. The decision-making process for a B2C perhaps is much shorter than a business-to-business purchase, especially for items that have a lower value, and sales process is often far simpler. B2C doesn't only include products, but digital services as well. This is a fast-growing area of online sales. There are a range of ways to conduct B2C sales, like mobile apps, online marketplaces, native advertising, and marketing directly to customers via social media sites. Business to business. In a B2B business model, a business sells its product or service to another business. Sometimes the buyer is the end user, but often the buyer resells to the consumer. B2B transactions generally have a longer sales cycle, but higher order value and more recurring purchases. Consumer to business. C2B allows individuals to sell goods and services to companies. This could include a website that allows consumers to outline services they need and have the businesses bid for the opportunity. This business model includes affiliate marketing services, which a company pays a publisher or affiliate to promote a service directly to customers via relevant websites. Often the C2B approach gives consumers the power to name their price or have businesses directly compete to meet their needs. Consumer to consumer. C2C businesses include many existing outline marketplaces, such as eBay or Gumtree, that connects consumers to exchange goods and services. These types of businesses typically make their money by charging transaction or listing fees, as well as through advertising on their site. Delivery methods for e-commerce. Businesses also need to consider how goods and services will be delivered to their customers. Once again, there are a number of different methods for owners to consider. First one, direct to consumer. This form of delivery relies on sellers providing goods or services directly to their clients. It cuts out marketplaces or other websites that act as a middleman to connect sellers with potential consumer. This model could include businesses that have a dedicated sales platform or online shop, or that provide services directly via their website or social media and the various features on these solutions. White label. White labeling simply refers to applying a name or a brand to a generic product purchased from an existing distributor. Similarly, private labeling is where a retailer hires a manufacturer to create a unique product for them to sell exclusively. This form of delivery helps businesses to keep their initial investment small, as they do not need to factor in cost of design or manufacturer, as they are essentially outsourced to another party. Often products sold this way are sold under a license or sometimes even a franchise, which may incur additional fees. Wholesaling. In a wholesaling approach, a retailer offers its product in bulk at a discount. Wholesaling is traditionally a B2B practice, but many retailers have offered it to budget-conscious consumers in a B2C context. Dropshipping. This is one of the one of the fast-growing forms of e-commerce, especially for new starters. Dropshippers market and sell items fulfilled by a third-party supplier, such as AliExpress, Printful, and many others. The role of dropshipper is to act as a middleman by connecting buyers to manufacturers, often through well-known online marketplaces like eBay or Amazon. Easy-to-use tools allow sellers to integrate inventory from suppliers around the world for their various storefronts. By buying goods at wholesale prices and selling them at retail, businesses are able to make profit by fulfilling orders for customers. As goods are often sent directly from suppliers to fulfillment warehouses, it means that owners don't have to lease or buy expensive premises and can operate with minimal overheads. Subscription services are nothing new. In fact, since the 1600s, subscription businesses have existed in England, allowing consumers to buy goods without ever setting foot in a store. With e-commerce, businesses are going beyond periodicals and wine of the month clubs, and today virtually every industry has seen the arrival of subscription services to bring convenience and saving to customers. Getting paid, of course, an important part of operating a business is getting paid. While a shop can easily take cash or card payments via their till systems, online businesses need to have methods for getting paid. There are many well-known options out there like PayPal and more traditional methods like the Visa and MasterCard services that for a small fee handle transactions between the customer and a business. Many online marketplaces also offer their own payment methods for consumers to use or have the payment methods above integrated into them. There has also been a recent development in buy now, pay later service, such as Klarna, which effectively offer short-term credit arrangements, usually 3-4 months, that allows shoppers to spread the cost of purchases. If you are setting up a business online, evidence shows that offering flexible payment methods can have a positive impact on the number of sales you achieve. Consumers like to have a choice of payment methods to suit their needs, so this is an area that is worth researching further. Importantly, many of these payment methods now integrate with online accounting software, which means that your accountant will be updated in real time without the need for manual data entry, saving you time and money. Invoicing. If you are dealing with B2B sales, in order to receive money from your customers, you may need to provide them with an invoice. Legally, invoice must contain the following details: full company name and registered of address, invoice date, description of the goods or services, total amount paid. It is also good practice to include the company's registration number, trading address if different from registered office address, invoice number, which should be sequential if possible, the name and address of the customer. There is then further information to include. If you are VAT registered, there are a variety of digital applications that can assist you with this process, which integrate with cloud accounting platforms. Bookkeeping and accounting for online sellers. You are expected to maintain appropriate accounting records for the company. Whilst there is no set requirement as how you maintain your records, HMRC requests that the records are adequate for the size and complexity of the business. As a minimum, you ought to maintain copies of sales invoices sent to your customers, purchase invoices for any supplier costs you incur, expenses claim forms for items reclaimed from the business by any directors or employees, including details of journeys for any mileage claims, petty cash expense receipts, bank account statements for the company account, statements for any company credit cards, and copies of any loan, finance, hire purchase, credit accounts that the company has with any third parties. The power of online accounting. As the e-commerce industry has grown, so has the demand for effective bookkeeping and accounting solution that integrate into the innovative platform that many sellers use to meet these record-keeping requirements. This has led to many innovations, not to only help keep sellers compliant, but also ensure that they have the real-time information they need to make key decisions. Taking advantage of accounting software like QuickBooks and Xero's dedicated online e-commerce solutions is certainly one way that many new businesses are achieving this. Cloud-based options in particular can really help you get a handle on your finances and allow you to fully digitize your bookkeeping practices. So you won't have to keep physical receipts, invoices, or sales records. These platforms offer easy integration. These platforms and connected third-party apps allow you to easily integrate your existing inventory systems and sales records to provide real-time, precise financial reports. Real-time collaboration, just like you can sell to anyone in the world, these solutions allow sellers to work in real time with their accountant wherever they are located and at any time. Automatic updates delivered via cloud-based solutions means that you can have instant access to the information you require, which will be continually updated without any input from you or your accountant, thanks to the automation that they offer. The importance of your accountant for any business, whether you are a limited company or a sole trader, you'll have certain tax requirements. This is why it is key to have an experienced accountant that can handle your weekly, monthly, and yearly bookkeeping, as well as your end-of-year tax report. However, beyond keeping your company compliant, truly skilled and proactive accountants can do so much more for your business. By working closely with an accountant, they can help to spot potential issues or opportunities on the horizon and offer advice that can reduce a potential tax bill further down the line. It is important that you choose an accountant that has experience with online sales and e-commerce and is well versed in the terms of difficulties that sellers face. I'll pass you back to Robert.
Thank you, Brian. I'll now take you on the journey of pricing. A lot of business owners really struggle with pricing. It's not unusual for them to price just a little lower than the competition or by plucking a figure out of midair. Needless to say, neither of these approaches are effective in a digital age where consumers can review prices instantly. By failing to grasp the importance of pricing when taking sales online, a business may unwittingly make their products or services less attractive. To help businesses with their pricing strategies, we will look at some of the established techniques they can follow. Psychological pricing, possibly one of the most commonly used forms of pricing, dates back to the 1800s, but remains effective even to this day. Psychological pricing relies on the strategic pricing of goods and services just below a nice round number. We've all seen prices and goods priced at $9.99 or £99 or 99p. Many businesses use this trick, and we're all well aware of it, but it's still effective even to today. Even though the price difference is negligible, irrational customers don't round up the price and perceive the item to be cheaper than it is and are more inclined to buy because of the £1 or 1 penny difference. The importance of 9, unbelievably, most people see a price ending number 9 as better value and more cost effective. This simple strategy may seem ridiculous, but has been proven to work time and time again. Relative pricing, also known as the race to the bottom, is another pricing strategy. Especially in the online world, ensuring your price is relative in comparisons with competition can be key, and is attributable mainly to the emergence of price comparison sites. Go Compare is one, for example. Knowing how to charge relates to several factors, one of which has to be how much the competitor charges. However, this shouldn't be the be-all and end-all, and shouldn't be the main determinant of your decision-making around pricing. Constantly trying to charge less than a competitor will squeeze margins to potentially unsustainable levels and may lead some consumers to think of your product as inferior. It is at this point where you may want to consider how your products and services are marketed. You may decide you want to be a premium brand such as Aston Martin or an economy brand such as Ryanair. Your marketing efforts should then reflect that business decision. One thing you should know, it's all contextual. Sometimes a price is justified by lots of different factors, not just the service or product on offer. People will happily pay thousands for a Rolex wristwatch that tells the time when a £5 watch will do the same thing. The product fulfills the same role, but there are other forces at play that determine the price, one of which is snub value, keeping up with the Joneses, for example. The same applies online, and sometimes it can be down to things beyond the price. Even the look of the website or the services offered alongside products can make a difference in how much is charged. A business should therefore look at non-product changes it can make that will justify a higher price. Be different. When choosing a service or selecting a product, customers will rely on their own opinion of the product, which are entirely subjective, but they also rely on price, which is objective. Prices for similar or identical products can be easily compared and may be a determining factor. Where prices are identical, this can complicate the purchasing decision of customers, forcing them to rely on a subjective decision, which may mean that they do not decide to purchase anything at all. In sales, this is referred to as analysis paralysis and means both businesses lose out. By purposely pricing differently to a competitor, you give customers a simple choice. If they like or require the same service or product equally, this can help to ensure a sale, although it may not always fall in your favor. Offer choice. Research has shown that by selling 3 products alongside each other, you subconsciously push customers towards the middle product. Therefore, if you strategically make the mid-price product more expensive, you can increase your average order value. The savvier online seller can also then use this technique to develop a mid-priced offering that is more cost-effective and therefore more profitable. You also have to have considerations for fulfillment businesses. Many fulfillment businesses, such as Amazon, now offer pricing software that can give an indication of current prices on the marketplace, the number of items sold recently, and historic trends. These are designed to help sellers establish potential profit in an item and indicate the right pricing. These solutions contain a number of innovations, including barcode scanning, which makes the sales process simpler and more effective. In many cases, goods can be scanned and added to a shop, with sellers just required to send goods to a fulfillment center to be stored and shipped as items are purchased. While these apps and software are useful, it is also important to take into consideration the points outlined above. If you're struggling to price an item, it may also pay to seek outside advice from a professional advisor, such as your accountant. Now to the important topic of VAT on online sales. For most goods, there's no difference between online and physical retailing in terms of VAT. The exception to this is digital goods and services such as ebooks and music downloads, which are covered by a separate set of VAT rules. As far as HMRC is concerned, if you're selling goods online, then you're using the internet as a tool for communication and distribution and for receiving payment from your customers. It's the same as if you were handing over the item to the customers and accepting their money in a physical shop. And whether you're selling online or from physical premises, this basic rule applies. You can only charge if your business is registered for VAT. You will need to register for VAT if the annual turnover of your company exceeds the VAT threshold of 85,000 per year. However, there can be benefits for businesses in registering if your turnover is below this amount, depending on the amount of VAT expenditure in your business. To register, you must submit a form to HMRC confirming the business details. Once you're registered, you're required to charge VAT on your sales at the appropriate rate, which is known as output VAT. The VAT which you incur your costs is known as impute VAT. Each VAT period, you must account for the output VAT you have charged to your customers and decide the impute VAT charge incurred on your costs from this. You must then pay the net balance to HMRC and file your VAT return with them each quarter electronically and pay any VAT liabilities via direct debit or bank transfer. As of April 2019, VAT-registered businesses with turnover of 85,000 or more must make VAT returns every quarter using a designated software package, which includes many of the cloud accounting solutions we use and offer for free to our customers. This is the first stage of the implementation of the government's Making Tax Digital program, which is intended to make the filing of most taxes online. The scheme is being extended in 2022 to incorporate other forms of taxation, including income tax. VAT rates. In the UK, there are three basic VAT rates. There's a 20%, this is the VAT rate for most items. 5%, some energy-related goods, and VAT and welfare and health-related goods, such as mobility aids, have a reduced rate. 0% is for goods such as children's clothes, are zero rated, while some suppliers are exempt from VAT altogether. You can check the HMRC VAT rates on different goods on their website and service pages for more details. VAT applies on delivery charges at the same rate as the VAT on the item. So you charge 20% VAT on delivery for goods that are 20% rated and 0% for goods that are zero rated. If you offer free delivery, then obviously there's no extra VAT to charge, as is all included in the price of the item, VAT inclusive. If you're VAT registered, you need to make this clear to customers on your website. The prices you display can be shown as VAT inclusive or exclusive. You do not need to list the VAT separately if you don't want to. Selling to customers overseas. One of the key advantages of selling online is that you're not restricted to a specific geographic area. Online shops can sell goods or services around the world. But in doing so, this introduces new VAT and custom requirements that businesses will need to fulfill, including changes following the UK's departure from the EU. The importance of the EORI number. Businesses must have an EORI number to move goods between Great Britain and other countries. It is a mandatory part of a custom declaration and is necessary to report and pay VAT as well. Businesses may only require one EORI number, or they may have multiple numbers, depending on the nature of their business and how they trade with the EU. Businesses need a GB EORI number to move goods between Great Britain and the EU. If the business uses a post or parcel company, they may tell the business if it needs an EORI number, but it is best to always check. If you already have an EORI number and it does not start with GB, you will need to apply for a new one. Businesses offering services to customers in the EU and not goods do not need an EORI number. It only affects the physical movement of goods over the border. EU, if a business makes declarations or gets custom decisions in an EU country, it will need to get an EU EORI number from the customs authority in the EU country where it is submitted. If a business moves goods into Northern Ireland or via it into the EU, then they should sign up for the government's Trader Support Service and acquire an XI EORI number. Businesses need an XI number to move goods between Northern Ireland and non-EU countries, including Great Britain. Make a declaration in Northern Ireland and to get a customs decision in the Northern Ireland. This free-to-use trader support service is available to businesses of any size, moving goods into Northern Ireland, providing guidance, training, a digital declaration support service, and support from custom experts. The rules of origin. Under the EU-UK Free Trade Agreement, the new EU-UK Free Trade Agreement, tariffs will not be charged where business can demonstrate that goods meet these rules and are predominantly of UK origin. The simplest way to think about the rules of origin is to give goods being imported and exported an economic nationality. This determines where they have been produced or manufactured, not just where they've been shipped to or bought from. UK goods seeking to enter the EU under a preferential tariff, which means that no payment is due, have to prove that they are from the UK under particular rules agreed in the Free Trade Agreement. Generally speaking, the Free Trade Agreement says that goods must be locally sourced or must have had sufficient work carried out on them in the UK to be tariff-free. This matter is in fact far more complicated than this is, and how the rules of origin apply to each sector or to each individual item exported and imported between the EU and the UK varies. And this only becomes more complicated when you consider more complex manufactured items. The first step for a business is to determine what goods is being traded. The World Customs Organization has a list of that classifies every product traded under tariff headings. Each product has a unique code that is grouped into broader categories. Once the good is classified, the next step is to establish its economic nationality as opposed to simply the country it came from. This involves determining goods value and where the contributions were made in adding value to the final product. If all materials were obtained and processed in one nation, it will be wholly obtained in that country. That would apply, for example, to agricultural produce, raw materials, and natural resources. However, it can be very difficult to determine origin for some complex manufactured products like cars or plants and machineries. In this case, the final product is determined by the location of the last substantial transformation. Complying with the rules of origin. For businesses to benefit from preferential tariffs when importing into the UK or EU, they must claim preference on their customs declaration and declare they owe proof that the goods meet the rules of origin. Requirements. The types of proof needed depends on the type of goods and where they're being imported from or exported to, but could include EUR1 or EUR-MED movement certificate, origin declaration, importer's knowledge, generalized scheme of preference form A. The length of time a proof of origin will be valid for depends on the agreement and type of proof. The UK and EU have agreed to a 12-month grace period. This means that until 31 December 2021, businesses do not need suppliers' declaration from business suppliers in place when goods are exported, but they must be confident that the goods do meet the preferential rules of origin. Businesses may be asked by HMRC to retrospectively provide supporting evidence that supports their declaration of origin. This evidence could include production records, invoices, accounting details, and supplier declarations. It is important that businesses retain this information. Import VAT. Goods that move into the UK from the EU from 1st January 2021 onwards will be considered imports, meaning import VAT will be payable and customs declaration will need to be made. Businesses must account for VAT on all goods imported using a postponed accounting system. Under this system, import VAT on goods is accounted for and paid via a company's usual VAT return, rather than paying it immediately at the point of entry. This means that rather than physically paying import VAT at the border and then reclaiming it on a subsequent VAT return, VAT is accounted for as input and output VAT on the same normal quarterly VAT return. Postponed VAT accounting prevents an immediate impact to a business's cash flow when importing. This system applies to all goods imported by VAT registered importers to the UK from anywhere in the world, if they are worth more than £135, including those from the EU. Accounting for import VAT on your VAT return. To account for import VAT via VAT return under the postponed accounting system, the goods must be of use in the business. A customs declaration must also have been completed, which includes the relevant EORI number and a company's VAT registration number where appropriate. You must account for import VAT on the VAT return when you submit a declaration that releases goods into free circulation from one of the following special customs procedures: customs warehousing, inward processing, temporary admission, end use, outward processing, duty suspension. You can only account for import VAT on a VAT return once excise goods are released for use in the UK. If the business imports goods that are not controlled into Great Britain from the EU between 1st January and 30 June 2021, they must also account for import VAT on their VAT return. Controlled goods are those that must have a license to import, or excise goods like alcohol or tobacco, which have additional duties on them. This rule still applies even if you delay the customs declaration, where a customer decides to record the information and tell HMRC up to 6 months later once goods are released. UK import VAT duty deferment. Businesses that import goods regularly can set up a duty deferment account that allows them to delay paying some custom charges, including import VAT. Through this account, a business can make a single payment each month via direct debit instead of paying for each consignment separately, as would be expected under the usual system of postponed accounting of import VAT. Under this system, you can pay the duties and import VAT you defer during one calendar month as a total sum, either on the 15th of the next month or on the next working day after, if the 15th is not a working day. This means that you can defer duties and import VAT for between 2 and 6 weeks, offering an average of 30 days credit. The scheme is open to importers or customs agents and freight handlers that work for importers and have an approved deferment guarantee or waiver in place. Regardless of the method of accounting for VAT on imported goods, checks to ensure that the data on the customs declaration is accurate will continue to be highly important for VAT purposes for all imports. Registering for VAT in the EU. Businesses must determine the country where a supply takes place for VAT purposes so that they know where VAT is due and payable. Businesses should be aware that they may continue to create VAT liabilities in other EU member states. This may mean that businesses in the UK require multiple EU VAT registrations within each member state that they trade with. Similarly, if you're an EU business selling to British customers, you need to register for UK VAT as of the 1st of January 2021. You are not allowed to sell products to UK customers if you are not registered for UK VAT. The one exception to UK VAT registration requirement is for B2B remote sellers. Remote sellers don't need to register for UK VAT if they sell digital products only to businesses and professionals, 100% B2B. If you think you or part of your business falls into this category, we recommend you confirm your particular case with the HMRC, a professional tax advisor. Businesses need to be aware that the rules for VAT registration differ from one member state to the next, and so it is important that they research this and complete the necessary registrations. Details of the various EU VAT rules can be found on the European Commission website. The upcoming one-stop shop. From July this year, new rules will be introduced under the new EU one-stop shop that may allow some businesses to register and pay VAT in one member state for all of their sales and activities in the EU. Under this proposed change, sellers of goods to EU consumers will see changes to their reporting obligations and potentially their profits. Where a seller is a small business selling less than 10,000 euros or £8,600 per annum of goods and services to consumers in other member states, they will be able to charge domestic VAT and report their sales below this threshold in their regular domestic VAT return. If they are a B2C seller dispatching their goods from a single EU member state, they will no longer be required to register for foreign VAT or complete multiple VAT filings in EU member states where they are selling their goods. Instead, they can opt to file a quarterly return under the OSS alongside their regular domestic VAT return. Importantly, non-EU sellers, including the UK, can use the OSS to register as a non-union taxpayer with the tax authority of the EU member state of their choice, except where they already have fixed establishments in the EU. By fixed establishments, this means that they have a base or a trading center or a branch or subsidiary in the EU country. This means that they can file quarterly returns under the OSS and only file a regular domestic VAT return in just one EU member state where they are registered instead of across multiple states under the current rules. In some EU member states, online marketplaces such as Amazon are deemed the supplier of the goods, which may mean that some online sellers could deregister for VAT in certain EU member states if they only sell via these marketplaces, as it will be the responsibility of the marketplace to collect the VAT at the time of sale. Alternatively, some businesses are looking to set up subsidiaries in an EU member state through which they register for VAT and supply goods via the existing EU VAT rules. Fiscal representatives. When it comes to VAT compliance in EU member states, businesses may need to appoint a fiscal representative. They are a special type of VAT agent for foreign businesses with a VAT registration in another country. They are responsible for the correct VAT calculations and reporting of VAT for their clients and are the first point of call for the local tax office in case of questions or audits. They are usually held jointly and severally liable for any unpaid or undeclared VAT of their non-resident clients. They therefore typically charge higher fees and often require bank guarantee or cash deposit to protect them against any client losses. Impact on services. Post-Brexit, there should be minimal impact on the supply of services to the EU or other parts of the world. Business-to-business services are treated as though they are supplied where the customer belongs, and that customer must account for the local VAT. This will mean that for UK service suppliers, they will continue to not charge UK VAT. For business-to-consumer supplies, UK VAT generally applies, and this will also remain the same. When receiving services, UK businesses may still have to apply a reverse charge to the receipt of services from non-UK suppliers. This ensures that there is no competitive advantage from sourcing services via non-UK suppliers. Sales of digital services to the EU. After the 31st of December 2020, all suppliers of these services to consumers in EU member states became liable for VAT in consumers' member states. The £8,818 annual threshold for cross-border sales of digital services to EU consumers no longer applies. Organizations will have to charge VAT at the VAT rate where the customer is based and declare those sales to the relevant EU member state. UK businesses that have been using the UK VAT-MOS union scheme can continue to use the system, but must register for the VAT-MOS non-union scheme in an EU member state. For businesses wanting to continue using MOS, they must register for the scheme by the 10th day of the month following their first sale after the UK leaves the EU. For example, register by 10 February 2021 if a sale is made in January 2021. Alternatively, organizations can register in each EU member state where they make sales. Check the EU's Europa website for further information about registering for VAT in the EU member states. Non-UK businesses that previously used UK VAT-MOS non-union scheme will now need to register for the scheme in an EU member state. Non-UK businesses need to declare sales of digital services to UK consumers by registering for VAT in the UK and declaring the sales via a UK VAT return. To declare the VAT charge, businesses can register for VAT in each EU member state where sales are made or register for the VAT-MOS non-union scheme in an EU member state of their choice. As of January 2021, businesses are no longer able to use the UK's MOS scheme to report and pay VAT on sales of digital services to consumers in the EU. Businesses that sell digital services to consumers in the EU have to register for the MOS non-union scheme in one of the remaining 27 EU member states. The Institute of Chartered Accountants in England and Wales understands many businesses are considering doing so in Ireland. Under the non-union MOS scheme, businesses wishing to use the scheme must register by the 10th day of the month following a sale. Alternatively, a business can register for VAT in each EU member state where sales are made. Why work with R. Johnson? Well, Whether you're starting out or just looking to grow and diversify your sales online, it is important to have a trusted advisor that not only understands the necessary tax and accounting rules, but also appreciates the unique trading conditions of online sellers. We work with a wide range and variety of online sales businesses, including startups through to large-scale fulfillment companies, delivering advice that adds value to their operations. By managing much of the day-to-day compliance work, we can free up entrepreneurs' time to focus on growing the business while helping them to keep an eye out for opportunities on the horizon. If you would like to know more about our services for online sellers, why not arrange a consultation with our team? Thank you. We're here to help.
Thanks, Robert. I have some questions here for you. Right. What type of services or support do you provide for the retail businesses?
Well, we look after every aspect of an online retailer's business. Our packages, subscription-based packages, covers their accounting, their bookkeeping, their tax requirements in the UK and the EU. We like to look after both the business and the directors behind it. So we also do tax planning for the directors as well as the business, and also help them with the preparation and filing of their self-assessment. On a monthly basis, we provide them with monthly reporting packs that they can review to monitor how their businesses are performing. And we also help them with cash flow, with partnership with Fluidly. We offer all our customers free Fluidly software, and that allows them to see their peaks and troughs, where they are likely to run out of cash, where they are likely to have surplus funds, and be able to use that information to make critical decisions about their business.
Thanks, Robert. What are the necessary steps required to set up a subsidiary for my business overseas? And how can I account for tax for both the parent company and subsidiary?
Well, setting up a subsidiary overseas makes your company a group company, or gives you a group structure. So it's something you want to be careful about the way you choose to set it up. For each country, the registration requirements are different, and there are a number of tax positions you may want to take in terms of establishing having a foreign establishment established in another country. So the steps and processes will differ for each business and the kind of service. But we can provide more information around that if you talk to us directly and you let us know more about your business, and we can advise accordingly in order to provide advice that is specific and relevant to what you do. Because each country is different and each country's requirements are different, and the type of goods you sell would also impact that. So it's best to get in touch with us to discuss more about that. Well, having a group structure could help you break into other markets and would help you control your tax filings in that country, and also the UK in terms of application of losses from sales.
Thanks, Robert. Next question. What's the difference between public liability insurance and employer's insurance? And what's the importance of professional indemnity insurance?
Employer's liability insurance is required if you're employing, if you have employees in the UK. If you employ anybody, you need to have employer's liability insurance, and it's not something you can sort of waive away from. It's a requirement, a key requirement. Product liability insurance, you will have to choose between product liability insurance and professional indemnity, depending on whether you offer a product or a service. If you're selling products, then you want to offer product liability insurance. And if you're offering services, you want to offer professional indemnity insurance. So that will determine which one your business should go for. Both cover the end users or those that may, as a result of the services you provide or the products you provide, be at risk or have a reason to claim against your business.
Thanks, Robert. That's great. Do you provide payroll services for businesses?
Yes, we do provide payroll services. We offer an integrated payroll service where we look after every aspect of your payroll, making sure leavers and starters are processed, making sure your employees get their P60s at the end of the year, their annual summaries, making sure your leavers get their P45s, helping you with the pension administration, setting up with Nest, Aviva, and Co, and making sure your employees are appropriately registered and enrolled for auto enrollment at the right time, and guiding you in that aspect in terms of helping you with bonuses as well, bonus calculations and compliance around that.
Thanks, Robert. What does CS01 form stand for?
Oh, that's the confirmation statement.
Yes.
Every company is required to file a confirmation statement every year, and it replaces the annual return. And it's just a statement confirming that the company records held about your business on Companies House register is correct and is accurate. And if there have been any changes to those records, then they need to be changed on the annual return or now confirmation statement.
Thanks, Robert. Can you be VAT registered and not a limited company?
Yes, you can be VAT registered as a sole trader if you so wish, or a partnership if you so wish. You can be VAT registered, without being a limited company, depending on whether you've hit the VAT threshold or whether you want to, you need to add VAT because of the nature of your business.
Thank you. Is there a time limit for backdating claims for VAT paid before registration?
Yes, there is a time limit, but aside from the time limit, there are a number of factors that come into play. HMRC want to make sure that when you are claiming for VAT, before registration, you are claiming for VAT that is relevant to your current business activity. So if you've sold goods in the past and you didn't claim VAT for them, you won't necessarily be able to reclaim the VAT on those goods you've bought and sold before you were VAT registered. However, you will be able to reclaim VAT for goods that you still have in stock when you were registered for VAT and you sold after you became VAT registered. So it's not something that you can just apply the I bought this before I was VAT registered within the time limits. You've still got to apply rules, the VAT rules correctly to make sure that those goods are actually goods that are VAT deductible. So there are services that you can deduct VAT from, or if you've enjoyed those services already before you became VAT registered, you won't be able to reclaim VAT on them.
Thanks, Robert. Next question. What other services do you provide alongside tax compliance and business formation?
We offer subscription-based services, and our subscription-based services aim to look after everything a business needs. Apart from that, we also offer advisory services, which lean towards a lot of funding support and tax advice. So there are bespoke tax advice that you may require, and we will provide that on our advisory core system. And in terms of the funding, we provide funding support. We help you with your cash flow, with your business plans. We help you access funding through various lenders that we talk to.
And do you support R&D claims as part of your service?
You have any more questions?
Yes. Can you hear me?
Hello?
Hello. Next question. Do you support R&D claims as part of your service? Looks like we've got you, Robert. Do you support R&D claims as part of your service?
Yes, we provide support around R&D claims. We will help you understand what you've done in terms of the project, and we would help you make sure that the claim you're making is valid. We'll go through what projects have been completed in the period. We will understand how you plan to complete the R&D project from the start, and help you calculate all the costs incurred in relation to the R&D project, and put together a strong, firm application to the HMRC for any claim. We will normally do that as part of your corporation tax calculation or an amended corporation tax filing.
Thank you. Another interesting question here. Have the rules on B2B supplies of services to EU residents changed since the 1st of Jan 2021?
Say that again, please.
Have the rules on B2B supplies of services to EU residents changed from 1st of January 2021?
I don't think they have changed. The B2C has changed, but the B2B has not changed.
Okay, thanks, Robert. When does an overseas seller have to register for VAT in the UK? And in what circumstances will it not need to register?
If they're selling below the threshold, they won't need to register. But if they've gone over the threshold, then they will need to register. But if they are also selling from the EU now, they will now need to register for VAT in the UK.
Okay, thanks, Robert. Another question, how do I know what VAT rates I should be using?
Depending on what goods you're selling, the standard VAT rate is 20%. There are only a few items that fall under the 5% reduced VAT rate, usually energy products. Things like books and children's clothing is zero rated, so you will apply 0% to those ones. But all the information about VAT rates is available on HMRC's website.
Thank you. A very popular question here. How often will I have to submit a VAT return?
It depends on what scheme you register for. If you did not register for any of the schemes, you usually submit VAT returns quarterly. Or if you register for the annual scheme, then you submit your VAT returns on an annual basis.
Another interesting one here. What if I don't get the information you need to compile the VAT returns to you on time?
Well, the responsibility for filing VAT returns and making accurate reporting to the HMRC are still those of our clients. We support them and help them get that right. We will, try to prod you to get the information across to us on time, and make sure you help you to meet the deadline and beat the deadline. But the responsibility is still the client's. There will be penalties for not filing VAT on time from the HMRC.
Thanks, Robert. Last question here. What is the reverse charge mechanism, and when can it be used?
Well, the reverse charge mechanism has been in place for a while now. There are just a few new additions recently, and that relates to the construction industry, where now businesses in that industry will not need to be adding or reclaiming VAT on their invoices. It will be the duty of the customer to now report VAT for both parties.
Well, thanks, Robert. That was very informative, and that was everything from me. Thanks a lot.